Hey, welcome to NAAIM Confidential Live. I'm your host this week, Branden Ducharme. We're joined by Paul Schatz from out on the East Coast. Paul, where are you at currently? You're out, you traveling
Okay,
or
back
back at
up.
home?
Out on the East Coast, this is the center of the universe, the East Coast. I would say
Yes.
out in Utah, out in California.
I will concede that you're closer to the center of the financial universe in New York than I am. However, I do believe I enjoy nicer weather out here.
There's no
Uh,
doubt, and probably nicer people as well. We're in Connecticut. I am unfortunately only about 20 minutes from Yale.
Okay. And we appreciate you taking the time to hop on. Markets continue to be crazier than ever. I feel in this last week the market has, I call it kind of a duck market. Like things seem to be okay on the surface, right? A little bit calm. We've had some of the lightest volume trading days in the S&P 500 that we've seen in a very, very, very long time. And yet under the surface, when you look at maybe some of the sectors, you look at you have some concerns, but then you look at some of the market breadth indicators, and there's some really bullish stuff going on. And so there's kind of a lot of different pieces moving under the water, right? Like the crazy duck legs is swimming, while the duck's nice and calm above the water. So an interesting wrap up to the week, to say the least. And you always have plenty of interesting commentary to go along with this. The name exposure index this week came in, and active managers, from a sentiment standpoint, were allocated on average in their equity positions 91.5% exposed to the markets. So the beta of that is relative depending on the type of equity position, but they're in, generally speaking. What what do you got going on in your head there, Paul?
It's not a lot in my head.
Well, yeah,
So I
I know you're thinking something.
right. So of course I'm always thinking something. So, first I push back on the notion that underneath the duck, the legs are kind of frantically moving. I feel like people are overplaying their volatility hand. Where did the VIX close today? The VIX closed today
12.55.
1255. The VIX was up in an up market earlier, then it closed lower. I don't think it's that volatile. The 5% decline, our thesis coming into the year, and I always make a big, bold, somewhat obnoxious forecast to begin each calendar year. And then I shove it up everyone's nose throughout the year. And then if I'm wrong, which I don't, because I'm always wrong on something, I do the mea culpa and walk of shame. But our thesis was a Q1 peak in the market, stock market, a Q2 bottom, a single digit decline, and then all-time highs by Labor Day. So we got the Q1 peak. It was later in the quarter. It was March, and then we had the 5% decline basically into the end of April low. And now we're already, I didn't think we'd be this close to new highs this quickly. I thought it'd be a longer story, but as you and I were chatting earlier, we're both fairly long with some leverage. So leverage is great on the way up when you're making money. And boy, you get punished quickly and furiously when you're wrong, especially that first leg off of a high. But I think there's a lot to forgetting about the exogenous geopolitical events like cowards flying planes into buildings, a global pandemic, Russia defaulting on her debt, stuff like that. Markets may set up for that, but I don't think markets really predict those kinds of lifetime events. But we both know markets do set the stage, the landscape changes for a pullback, for a big rally. So overall, I think the landscape is pretty good, through summer. We're going to get a pullback, sure, but I think we're still in that, buy all weakness and perhaps prune into strength.
Okay. And what's your take? Are you looking at the market as a whole? Like, are you looking at the large cap indexes, talking just, S&P 500 index and focusing on that? Or are you, looking more at sectors and saying, hey, there's some great stuff going on in these sectors, and when you have great strength in the sectors, kind of consider pruning that, and buying some weakness at that time and kind of rotating through sectors. What's your general thesis?
Yes, all of the above. So on the index side, we've really been overweighted in large cap tech, large cap growth, like everybody else, which is a very uncomfortable spot to be in. I have surgically, I guess maybe the best word, we have taken multiple stabs into small caps
Okay.
because it's not a comfort spot. We haven't had that whoosh lower in small caps. They just underperformed most of the time. They've had these, short-term bursts. So literally today we just moved a whole bunch of small cap money into the Dow and large cap value. Is it a position for the summer? No, I think it's something short term, but they began to move and we moved. More granularly, for sure, the sector space. This morning I wrote about the utilities. 3 weeks ago, 3 weeks ago, I was all jacked up to buy utilities. It was checking off every box but one, and that was the downside price objective on the utility index. And I needed another, I forgot, 6-8% lower, maybe it's a little less. We never bought. Utilities for the last 3 weeks have literally looked like an AI stock. And I'm like beating, I'm like, oh my God, we were so close yet. No. So what do we find out in the last couple of days as utilities have melted up the right-hand side of the page? We find out that now it's an AI story. Of course it is, because just like with Bitcoin 5 years ago, someone realized that they needed extra electricity for AI. So now stodgy, boring old utilities are now quasi-AI plays. I purely speculate without anything factual to base this on, but I think somebody wanted to lighten up on utilities in a big way, and they started this narrative to sell, to create liquidity and sell. Can I prove it? Absolutely not. Is it a conspiracy theory? Maybe, but it certainly makes sense. So, getting back to the sectors, the semis haven't traded great lately. And while we own pieces, in the first quarter, we sold and we pruned a lot of our tech and AI. So, people were lighting me up. How did you sell half of your NVIDIA and half of AMD? And we sold all of Broadcom and Marvell and Micron and Tyler Tech and a whole bunch of other stuff. And we bought this boring, garbagey stuff that nobody wants. We bought Staples and Hershey's and Clorox and Pfizer, Bristol Myers. Oh my God, what else? Dow Chemical, Berkshire Hathaway, I think. Stuff that everyone makes fun of you for owning.
Yeah.
I'm not that smart to begin with. So if we can do something, a quarter intelligently and thoughtfully and take some risk out of portfolios, count me in.
Okay. So how do you come to your analysis on that? Is that not to say, give us your secret sauce, but what's your overarching theme on how you determine the strength and the weakness that you feel, needs to be bought or pruned or whatever? Is fundamentals, technical analysis, a combination, fully quantitative?
So first, and I know I'm on an island by myself, I think secret sauce is complete and utter nonsense and BS.
Okay.
At the end of the day, when we're done and we retire, my view is no one's going to pay a penny for your IP. It's worth nothing because we've commoditized research and quant and signals down to single-digit basis points. I think people will pay at the end of the day if you build your own book of business that you can monetize with a merger, a sale, whatever. I also think people will pay a lot of money to learn how you raise money in the industry. So your sales and marketing process. Regarding how you manage money, I had a potential hire in today, a summer intern. So he's asking questions like, what do we do? Are we just like you? Are we quant? What are we? And I said, we have 18 strategies. So some were just momentum based. we are strictly price and volatility, and we hop on the bandwagon as the bandwagon's leaving. Like all of a sudden, everyone's a Knicks fan right now because the Knicks won a playoff series and they're playing great basketball. I hate the Knicks, but I'll root because they're kind of local. I'm much more a Ranger fan. But so that's part of our models. We hop on the bandwagon. Other models are strictly mean reversion. We buy weakness and we sell strength, and we buy weakness and we sell strength. And if we buy weakness and we're wrong, we get stopped out. And if we sell strength early and we go to cash or some kind of short-term equivalent, and the security runs away from us the upside, oh well, so be it. So we're on both ends of the spectrum. I run an individual stock portfolio, which I enjoy. I think it's fun. We have like 45 names in the portfolio. So, and that has a little bit of everything in it. It's a mishmash. So I wouldn't say we have any one specific discipline. I like them all. I mean, I don't love doing fundamental research because I'm crummy at it. And I'm crummy at a lot of things, but certainly I'm that. So I have somebody else do it. And so that's how our models are. They're just all over the lot. And, you know, if you called me after this and said, could you share your most successful model, how we do it? Of course I will. You're not my competition. You know,
Well,
Ryan Redfern's not my competition. The competition is Schwab and Fidelity and the morons at the wirehouses.
yeah, I'm going to not touch that one with too much vigor. But what I will highlight is that I have always appreciated that in the NAAIM organization, that there is this free flow of kind of information and ideas and collaboration with, you know, people that are not in the organization, likely look at it and say, man, you guys are all competitors, and you get together and just share your ideas and tell each other what you're doing to be successful. And, you know, when you go out for, you know, great events together and have these awesome conferences, it's just, they can't figure it out until you get there, you know, and people are just awesome. I've learned so much being a part of
people who
the
say, I don't
organization.
understand why you share, you know, don't understand what the industry is all about. Go to a hedge fund conference. You can't even get if they own a stock or not. Everyone is so secretive, as if their IP is that great. And it's not, because, as we know, hedge funds, almost every time horizon you look at, 3 years, 5 years, 10, 20 years, have underperformed. So
Yeah.
I subscribe go to a hedge fund conference. Those guys should share because their performance is that poor. I feel like when I leave, you know, so I've been going to NAAIM conferences for 30 something years. And my goal is always the same. Leave with one nugget, a single nugget that I can use in the business. So I did a call with a prospective NAAIM member, and I said to him, this is a true story. In 2005, someone in a passing conversation having cocktails on Tuesday night, one guy gave me an idea, and that idea has resulted in more than $1 million of revenue since 2006 when I implemented it. One nugget, passing cocktail conversation, $1 million in revenue. So when people say to me, oh, I only got 2 things out of the conference, 2 things is amazing. Like when I come home, you won't read my writing because I have chicken scratch, but I have like a book of things that I write down, and most I don't get to. I try to get to 1 or 2 things, and that pays for my membership for decades on end, plus the conferences.
Yeah, I know what the community, the NAAIM community as a whole, has done for me in my ability to implement new ideas in my practice and manage things better is probably already paid for more than the lifetime of the membership going on forever. So great that way. And I've always had a lot of fun with you at conferences. Obviously very loud. We both have loud personalities, I think.
No,
Is probably
I don't.
So tell me, so you dropped some new commentary today. The market's all about the you call it the Utes and the U's, right?
Yes.
What do you
And that was
expand on that
just
for us?
that was just a commentary on, all of a sudden, you know, you turn on any financial program, everyone's talking about utilities, which you mentioned earlier, because they melted up. No one wanted them 3 weeks ago. So my comment was, if those of you guys who watch, I can't believe you haven't seen My Cousin Vinny, but with Joe Pesci and Fred Gwynn and Marissa Tomei, and Joe Pesci talked about the Utes, and Fred Gwynn, the judge, says, "What's a Ute?" And he said, "Youths." Well, Utes are utilities, and they had melted up because someone decided the new narrative was AI. And I was explaining to someone in the office today, McDonald's stock in 1973 traded at $77 and the PE was 75. 7 years later, their earnings look like a perfect 45-degree angle. They just printed money for the next 7 years. The stock went down 50% and it went down to a PE of 8. So I mentioned that today because we were talking about AI. The market may be pulling forward all of those earnings in a short period of time. I don't know, but it's certainly a plausible scenario to keep in the back of your mind. Like, none of these companies are making any money really from AI right now. They're going to make a fortune. Well, McDonald's was going to make a fortune in 1973 going forward, and they did, but the market valued that stock differently. So it's just, there's always nuggets and tidbits to keep in the back of your mind and not become a lemming and follow everybody.
Well, I think to a certain degree, being a lemming is just a strategy, right? I think what is the guy that's like, he's the professor of valuation. I can't remember
Schiller?
him. Who?
Bob Schiller?
No,
Jeremy Siegel?
no.
Richard Thaler?
No, I'm gonna find it. I'll find it. I'll message you later. We had to, anyways. My finance professor is gonna be really disappointed if she sees this because she was in love with the guy, basically. And anyways, he said, so it was a class on valuation, right? And
Jeremy
so,
Grantham?
no, you're
Come
gonna
on.
you're making, yeah,
Killing me.
no, I I'll find it.
All right.
But anyways, what he said was, everyone's a lemming no matter what. Anyways, your behavioral tendencies can't really stop you from, like, it'll force you to be a lemming, right? If you just see the market going, straight north, it's just at a certain point, it's too difficult to stay out. You become a lemming, right? And so what his whole thing was, lemmings, what they do is they run off the cliff and they drown, right? And he said, so valuation is, you're still a lemming. Valuation gives you a life vest. That's it. It was like, and so there's some value to that. But I think what you're trying to describe about McDonald's too is, so the market priced in, the present value of all these future earnings that did come to fruition, but everyone bought in and said, I want all those future earnings and I'll pay today's present value for all those future earnings. And then you just have the guys that look around and say, well, I can just sell today and have all the future earnings in the present. Why else am I going to hang on to this? And that's how you get the correction and the reversion back down to, the appropriate, long-term valuation. And if I'm understanding correctly,
The single worst timing tool on earth. It is horrific. It's a good piece of background info, but I always feel like anybody who says they use valuation as a primary tool is someone who has really bad performance.
I think valuation over a long enough period of time can be a useful tool. I think most people don't have the time frame to let the valuation work. If that makes sense. I just, people don't have the attention span or the staying power or whatever it may be. But obviously, some of the original greats and even their, like Graham, valuation, Buffett has done a lot of work on valuation, and Munger, they added some additional stuff to their models, like, beyond just the valuation. But, their time horizon is fine. Go, we're buying this under the hood of Berkshire. Go sell
Infinite.
Berkshire. Doesn't bother us. Go sell your shares in Berkshire. We don't care. We got our thesis. We got our understanding, our valuations. We're solid, and we're not selling. We're legitimately not gonna, sell for however long we need to not sell for. And so there's that. But you're absolutely right about it being a horrible timing tool then, because if you're input in the model, the timing model has to be a holding period of 100 years. You're not really timing
Right.
anything.
Well, if you go look at I'll pick on GM. Why not? I mean, GM and Ford, I think their PEs are single digits. And GM stock in the last 15 years is up like 15% total return, not even annualized.
Mm-hmm.
So if you started buying it after they recapitalized the company in 2011, you don't have much to show for yourself. So that's a horrible timing tool
Yeah.
because the stock still hasn't really participated. And the flip side, if you decided that at some point several years ago, NVIDIA was way too expensive, or Google or Microsoft, you missed out on an enormous boom.
Yeah. Well, I think all the people that say technical analysis or active management can't work in any way sort of forget that the S&P 500 is an index that is a rules-based actively managed strategy, essentially, that as stocks get larger, the companies get larger, it moves through a heavier weighting in the index. And so that picks up the price action of companies like NVIDIA, that even though the valuation says, hey, it's way too expensive, it's all this, right? It gets a bigger portion in a portfolio. It gets a bigger share as the momentum carries it to be a larger company. And you can argue that that's a derivative of the a derivative of them, doing more business, right? Becoming a bigger business. But at the end of the day, there's no rule in the S&P 500 index that says, if the company increases their earnings, they get a bigger weighting. It's based solely on price.
Market
So
capitalization, right?
it's based on price.
Yep.
So
And let's not
yeah.
forget that, qualitatively, a group of people sit in a room and decide to kick out one company and add another company. So look, and they do it in the Dow and they do it in the Russell. They rebalance the indices.
Mm-hmm.
I mean, that's a fancy word for making a qualitative timing decision.
Yeah. Yeah.
So
So tell me more about what you mean. Is that you're saying that that's the process for the committees that determine what's in or out of the indexes on those
yeah,
indexes? Yeah. It's committee
they
driven. It's
make.
not even rules based.
I mean, they make decisions, then they justify them, and I don't have a problem with that. And look, any portfolio manager that doesn't just follow an index, frankly, how are they not active? Now they may say we don't practice this; it's terrible, blah blah blah. But when you decide to take NVIDIA from a 5% position in your portfolio to 3%, that's an active decision. You're trimming and pruning. Okay. And when you decide to take, Tesla from 0% to 2%, something triggered that decision. It wasn't a passive one. So whether you buy or sell in mass, all in, all out, or in 2% increments, it's still active management. Now,
Yeah.
we get so wrapped up in the labels and the monikers. To me, it's irrelevant. And frankly, most clients, most important, most clients don't care what you call it or what you do. They just want to know you're looking out for their best interest and taking care of them. That's why we're in the business.
Yeah. I think that's totally true. And I one of the things that I always try to help people understand is they probably are more active, just like you're saying, than they think. But there's this whole, movement about the low cost they always call them passive, index funds. It's like, okay, it's managed passively by the fund company in the sense that they just get the exact exposure to whatever that index is. But that index is an actively managed idea anyways. And then even on top of that, if you say, okay, well, I like the S&P 500, I have yet to ever see a sizable portfolio come across my desk that their advisor had them in just, an S&P 500 index fund and nothing else. There's always more decisions to be made than that. Okay. So, which index, how much, and to what allocations, right? And to what is the goal or extent of the client, right? Like what's the purpose of doing any of this? And so that's where I try to help people understand, if you're an advisor, even building a portfolio of low cost index funds that, the intent is to quote unquote buy and hold these low cost funds or whatever it might be. If that's your thing, you're still actively making some decisions there. And then on top of that, if in my opinion, you can produce some really good alpha, or advisors could, if you can strategically look at a portfolio when it needs to be rebalanced for your clients, right? So, Mr. Client calls up and says, "Hey, I need a distribution of, $10,000." Okay, well, like, how are you freeing up that $10,000, right? You got to sell something.
Yeah.
And then that means if you're selling something, now do you have to rebalance the whole portfolio? And if so, when do you do that? You know, there's,
Well, look, you mentioned the low, people, everything is on cost, 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 cost.
yeah.
I feel like in our industry, we've taken that. So it's like, who in their right mind, seriously, who goes and lives and shops only on cost in the world? I don't know anybody who goes and says, give me the cheapest car, give me the cheapest insurance, give me the cheapest bottle of wine. A pioneer, Jim Simons from Renaissance Technologies, died today.
Mm-hmm.
He is arguably the most successful money manager in the history of the universe.
Mm-hmm.
He ran a quant, he was one of the first quants, mathematically based fund, only hired PhDs in quants. It was like the firm. It was an unusual place. He died. His performance was off the charts, like head scratching. And his fees were, his top fee was zero management fee and 50% of the profits. 50. You make $1, he gets $1. So all this, all these conclusions that the lowest cost is the best is nonsense. Low cost should be a factor, but to say it's the single biggest determining factor in investment success is insane.
I think that sentence can end with a period. You're pretty definitive about that.
Yeah.
I, it's yeah, it's interesting. How did you, maybe a really interesting question is, how did you come to that conclusion? Like when did you get into the business, and when did you decide that active management was going to be a factor in your practice, or you felt like you had that moment in your career or life where you felt that was what was in the best interest of your clients or the people that you wanted to work with or serve?
I came into business in 1988. I don't even know if you were born.
Nope.
So there you go. My dad was in the business. My grandfather was a big investor. I came in the business and I got two stocks from my bar mitzvah in 1979. And I looked at them every day in the newspaper. Every day I checked their price. And then in 1987, the market crashed. So all of a sudden, the two stocks I owned were down like 50% in a matter of months. I'm like, this is insane. And so my dad gave me one of Joe Granville's books. Joe Granville is one of the greatest maybe the greatest technician ever. So I started reading his books when I was in college, and my first job was at Shearson Lehman. The worst thing ever happened to me was the first two trades. So I was never a retail broker, but my first two trades at Shearson, I doubled my money on two gold options in September, right after I started working. So all these guys would work forever and pound all this research, and I came in, I made double my money on two option trades. Well, then I didn't have a winning trade for like 2 or 3 months, and I lost a fortune. And they let me lose because it wasn't a lot of money at the time on the desk, and they did it so it was a tough life experience to make a ton of money first and then get pounded into oblivion. And it taught me that managing the downside was way more important than worrying about the upside. The upside will always take care of itself. So I started with my career, reading Joe Granville's books and losing money. And that's what kind of brought me full circle to having some kind of focus on the downside. Call it whatever you want. Back then, it was called, trading and timing. Today, you want to call it tactical or active. It doesn't matter to me, but it's definitely having at least an eye on the downside.
That's manage the downside and the upside takes care of itself. I think is the quote. I think someone said that.
I think Paul Schatz did.
Paul Schatz, official quote of Paul Schatz.
And I hate people speaking the third person. I did it intentionally too. But yeah, it's and look, it will serve most people well. I've come across people who say to me, they come in for a meeting and they say, listen, I saw you somewhere and I wanted to meet you and listen to your story, but I'm an MPT guy. I'm a strict 60-40 guy, and they're okay with the downside. If somebody's okay with the downside of whatever portfolio you put on, like I'm okay losing 60%, okay. Then they know the downside, they know the upside.
Yeah.
That's not a candidate for us to work with them. That's all right.
Well, I think even when somebody says, hey, I'm an MPT guy, I want 60% equities and 40% bonds, you still have, there's a very important question that still needs to be answered, which is, okay, what equities and what bonds? You still have to, someone still has to make further decisions about what goes into the portfolio exactly and how that is managed.
And if you go a step further, I'm preaching to the choir. I always was a critic of the target date retirement funds that came out in 2006 with that Pension and Protection Act, the ERISA one. And I was so skeptical because all their back tests and all their data mining was during periods where bond prices only went up.
Yeah.
So all of a sudden, and it took until the global pandemic when the 10-year was like at 0.5%, 45 basis points. So now you've had essentially 3.5 years of the bond market not delivering. So all those people, I heard for years that the PIMCO Total Return Fund, people would say it's like an ATM machine. It only spits out money. And we know the bond market's bigger than stocks. So I warned for years, one day they're going to come take the fixed income people's money and they're not going to understand why. Now we've got 3 years of fixed income, really stinking it up. So that target date retirement portfolio in 2022, did bonds offer ballast? No, they lost 13+%. So all those people who said, don't worry if stocks are down, I got my bonds. Well, bonds lost how much as stocks did that year.
Well, depending on what your duration risk was, you came out even worse than equities. And I would argue that you really have come out significantly worse than equities because equities recovered and the bonds really haven't, right? So
and they never can recover.
Well, if you take a 25% drawdown on bonds and you're like, well, cool, I'm clipping coupons on my original principal at
0.5%,
0.5% a year. I mean, my friend, you have a lifetime to go before you make your money back there in the coupons, right? You're
literally
really hoping. You have to wait to maturity to get your principal back, and the opportunity cost on that is quite disgusting. But
you know what it was like, Branden? It was like, I remember I was on Bloomberg in February of 2000. And I said, I think the .com stuff's going to go down 75%. I just don't know when. But I said, I owned one .com stock, Globe.com, I think. And it went to zero and I lost it. And that was a good lesson for me. But a lot of those stocks, it was kind of similar to how the bond market was kind of came together in the pandemic. Most of those stocks, nobody ever made their money back because they went to zero. Bonds aren't going to zero, but good luck with the 10-year at, what would be close to 450, 450.
Yeah.
And the 10-year, good luck buying a 10-year bond at 10-year note at 0.5%. And now it's at 4.5% and ever recouping what you invested.
Yeah. Well, it's tough. Bonds, but I say this all the time, especially with the name. I really started to learn this lesson around being around the organization was that bonds drive the entire market, and it is the most fascinating place. And you can manage bonds so differently. Like when I was in school, and I've said this before, when I was in school, it was it was during QE periods and loose policy, and it was all about equities, and it was all about how fast could you make money and leverage and all this stuff, right? And um, I remember just reading towards the end of school, I read for fun a book called "A Total Failure of Common Sense," and it's a story of Lehman collapsing.
Oh.
It's written by what is this guy's name? And I can never remember this stuff when I get on the spot. It'll come to me. Uh, Anyways, he was a trader. He traded distressed debt. He's the guy that you're old enough, Paul, to maybe remember this website. Convertbond.com was his website. Anyways, he was like a
I
convertible
know it
bond
wasn't John
specialist.
Merriweather, but that's along the lines because John Merriweather blew up in the in 1998 with long-term capital, but it was probably along those lines of.
Larry McDonald is his name. Lawrence McDonald.
Oh, I know that. Yep, I've been
Yeah.
on TV with Larry McDonald.
Yeah. So his book, it was awesome, but just uh I read that book and it opened my eyes to the way that bonds really trade when you actually look at the bond market outside of just, the ag index or, an ETF or mutual fund of
The ag's
bonds.
full of treasuries.
Yeah, well, just whatever you want to look. It's just there's a whole world of bonds that get overlooked by investors because, the difference between senior bank loans with floating rate is a world apart from the 10-year treasury, which is a world apart from high quality corporate that has 1 year to maturity, right? It's just it all trades so different, and you can build some really cool portfolios that meet a really client specific objectives with bonds. Um, but no one ever thinks about them because so rarely do you see bonds. If you have this secular cycle that we've seen in bonds where, the prices just kind of went up steadily, as the coupons were clipped and rates, just kind of came down for, man, what was it? 30 years. It's like a 30-year cycle
40.
and 40-year cycle,
1981
right?
to 2020, 40 years. Yeah.
Yeah. And now and it's just boring for that whole time. And there was never like the catalyst to the upside, right? Now you see some people that start to notice it because if you're trading the long end of the curve, you have the up 10% and the down 10% months in the long end of treasuries, which is like people are like the treasuries. I thought that's safe. It's like I mean, what's your definition of safe?
So people
But there's
don't
certainly a lot of
understand.
volatility.
No, they don't understand that once you buy, so we have a portfolio where we buy cash A- or better rated corporates for clients. We buy to die with them. People don't understand. Once you buy that treasury bond that you mentioned, it fluctuates like a stock does. It goes up, it goes down. If you hold to maturity and the issuer doesn't go insolvent, you get your money back plus a stream of interest payments.
Yep.
So what we do is I go A- or better rated because I want a little bit of cushion before it goes to triple B, then junk.
Mm-hmm.
So we charge obviously a lot less because it's almost a passive asset. We don't trade them, and clients live on the interest payments. We do the same thing with some taxable municipals. I mean, they're boring. People are like, oh my God, what? But that solves a problem in an overall portfolio.
Yeah.
So when you buy the mutual fund or the ETF, they never mature except for the bullet shares because there's no period where you get your money back, where your bond goes to par and you get your money back. So. I mean, I like the bond market. I think it's enjoyable. Obviously, it's less volatility and more. I think the research is more thoughtful than on the stock side.
Yeah. Well, it's a whole different world, but it certainly can. The movements in the bond markets and the repricings of those bonds can certainly drive the equity markets.
Just like currencies.
Oh yeah.
Well,
that's a whole
stocks
nother.
are here, bonds are this big, and then currencies are that big.
Yeah.
People always focus on stocks, but you get the currency market right, a lot of things go well for you.
Yeah. Yeah. That's an interesting perspective. Probably correct. Um, I'm gonna have to do some more research on that one. That's interesting. Yeah, like this is the stuff I'm talking about. I always pick up so much stuff when I'm talking with NAAIM members, so you're obviously a wealth of knowledge. Um, Paul, anything you care to share with people before we hop off?
I think we covered a lot. I mean, I'll just say this, and it's not new. I'll make two comments. Maybe they're long-winded. So one, in 2000, in April of '08, I wake up and 3/4 of my business is through a macro hedge fund. And the partner calls me and says, "Hey, look, we made a decision to unwind the hedge fund. We don't like the environment, so we're returning all the money." So imagine you wake up one day and 3/4 of your revenue goes out the window. That's not a comfortable position to be in. So after a month of feeling sorry for myself, I mean, not a month, 3 weeks of feeling sorry for myself, and I called probably my 10 closest friends in name. I'm like, look, I am really screwed because most of my revenue went away. And it didn't take long to brainstorm. A bunch of us got together multiple times. There wasn't Zoom or Teams back then. It was a good old telephone. And kind of solve my problem in short order. So when people are like, oh, some guy once told me he outgrew NAAIM, and I'm like, dude, I almost went to zero in my business, and NAAIM got me out of it. You don't outgrow NAAIM. Maybe your business grows, then you should give back to other people. So in closing, I would say this. Too many people put too much effort and energy into the latest and greatest black box. That's not why you raise money on the retail side. Institutional side, different story. On the retail side, you raise money because you have a process, you have infrastructure. People want to trust you and believe that you're going to do right by them. They don't give a rat's rear end about where the VIX is in relation to the market, nor what moving average is crossing another moving average, nor where RSI is. Very few people care about that. I wish a lot of the stuff I learned over 35 years of making almost every mistake, I wish I learned that, because when we pivoted is when we started raising our most money. So with that, I would say, hopefully you'll see everybody in Dallas at the end of October.
I'm very excited it's in Dallas again. We really like Dallas. So, so officially announced, the NAAIM Outlook is in Dallas, is what you're highlighting there.
Yeah, we had a special deal offered at UK, which won't be repeated, but there'll be an early bird special. I think it's oh, my calendar up. It's the last Monday and Tuesday of October at the Hyatt inside of DFW Airport. So it's convenient to fly in, convenient to fly out. We already have some of the agenda done. It will be a great Outlook meeting. That's my commercial.
That is well, I'll add to it. Outlook, I enjoy more than Uncommon Knowledge, actually. Uncommon Knowledge is an awesome conference. It's a bigger conference. There's a lot more stuff on practice management, a broader array of speakers. I cannot think of something I would do in October that would be more important than going to Uncommon Knowledge. That helps me calibrate myself for almost the entire year. It really helps me close out the year, understand and get clarity on where I need to take things in my business. It helps me give me so much insight about the markets and the forecast for the coming year. It is just an absolute dynamite of a conference. So I will see you in Dallas.